So have you decided who to listen to regarding the real estate market? Because depending on who you're listening to, you're getting really different types of information, and much of the information out there is bad information. It is distracting, it is not helpful, it will lead you astray. I've got the real information about the real estate market. So let's go ahead and talk about what that means. I am Justin Miller, co-founder and principal at the Chong Miller Group. We help people build wealth through real estate. We help people buy and sell homes, especially here in the Las Vegas Valley. Every month I put together a market update video for single family resale homes in the Las Vegas Valley, as well as a companion market update for resale condos and townhomes here in the Las Vegas Valley. And I'm also doing a series on the YouTube channel, Building Wealth Through Real Estate. This video is the market update for single family resale homes in the Las Vegas Valley for March of 2023. That means the data that we're looking at here are generated from February, and therefore we're looking at what happened during the course of the month of February with some data looking forward. And of course, we do month over month comparisons so you know how February looked relative to January of 2023, and year over year comparisons so that we have some information about how the market's behaving this year in February relative to last year in February. Now remember, as I've said in multiple of my prior videos, year-over-year comparisons since the pandemic have been very challenging. First, because the pandemic itself brought us to very low levels with very quick escalation then in numbers of transactions, without really damaging prices during the downturn in sales volume, but with significant upward pressure on pricing because of low inventory. That continued throughout 2021, that continued throughout the first half of 2022. And so year-over-year comparisons, looking at things from the first half of 2022, will be challenging when we get to the second half of 2023. Similarly, year-over-year comparisons are going to be a little distorted because the second half of 2022 was we saw a significant downturn in level of activity, a small increase but significant in inventory, and we did see a correction in pricing happening in the second half of 2022. So be a little bit careful with the year-over-year comparisons, and I'll specifically comment about that as we go through the data. So before we look at the first set of data, let me comment the Federal Reserve has continued its attack on inflation. This attack has been a whole bunch of name-calling, yelling type stuff, plus increases in the federal funds rate, and actually some buy down on the level of assets being held by the Federal Reserve. This has been restricting money supply. This has actually been removing money from the economy at the same time that interest rates, specifically the policy rate or the federal funds rate, has been increasing. And that attack started at the beginning of 2022 and has continued apace. As I record this on March 8th of 2023, Chairman Jerome Powell, chairman of the Fed, just finished his second day of testimony before Congress, wherein he's declared that the Fed continues its war against inflation in what so far has been a very non-effective war. Inflation has come down a little bit, but it's not collapsed. Interestingly, the employment ratios have looked incredibly strong and continue to look very strong. We have seen significant hits being taken by technology industries, and we've seen some level of correction taking place, and we'll look more at one of the details about that near the end of the video, but some correction taking place in the real estate market. Otherwise, the economy is actually showing itself to be incredibly durable. We are in a secular inflationary environment, and the Fed can rant and rave all it wants, but while they can push us into a recession, they're not going to cure inflation at this point in the growth cycle for the U.S. as a population and as an economy. So the Fed is tilting at windmills, banging their heads against the wall, and they can be very destructive. But I do want you to keep in mind what it actually means. As we go through the data, we'll keep hearkening back to what the Fed's doing, what it's trying to do, and whether or not that's actually working, and how that spills over into residential real estate. And remember, I take out new construction because they are a different population of data. Most people, including the Las Vegas Realtors Association, do not understand that statistically, including new construction, actually corrupts the data and leads to incorrect analyses and therefore incorrect assumptions. The data I'm presenting you is the most accurate version of the data and analysis that you will find anywhere as related to Las Vegas real estate. Okay, so let's go ahead and dive into the numbers. Every month, the first number I look at is price. The median sale price in February was $415,000. Now that's an interesting number because that's actually the same number we were at in December. In January, prices had popped up a couple $1,000s, and we've now come back down. So the number in January was $418,750. We've come back down that $3,750, or we've come down 0.9% from January, but we're actually flat to December. So kind of interesting. It means that we've hit the bottom and we're kind of bouncing along the bottom of what I think is the pricing levels that we're going to see in this correction. As I've actually said over the past couple months, I think that we're bottoming out here in the first quarter. So this is the second month of the first quarter. We'll see what March does as well. And that we're going to find stability and start going up in the second quarter of 2023. So we're down 0.9% from January. We are down 7.8% from $450,000 1 year ago. So the end of February of 2022. Now that's interesting because if we think about a correction in the asset prices for any type of commodity, we tend to think of corrections as occurring from sort of down 10% to down 15%. We talk about bear markets being down 20%. Crashes are down very considerably more than that, down a third or thereabouts. So we're nowhere near a crash. We're not in a bear market on pricing for houses. We are not really even year over year yet in the correction territory, although in reality we've come down from $480,000 in May of 2022, and therefore we've come down about 12.5%. And so we could talk about being in a correction, but it's a fairly mild correction at this time. We are down 7.8% year over year. Now, for those of you who've been watching me for a while, you know I look at pricing in another manner as well, and that is price per foot. And I emphasize this every month just because I want to make sure you're aware. Price per foot is not a great way to price a property, nor is it a great way to decide what you're going to pay for a property. It's a very misleading measure, but in looking at the market overall, it's helpful because it provides some information about the internals of the market, sort of what's happening on the higher end of the market, what's happening on the lower end of the market relative to the median sales price, where median sales price is literally that middle transaction. So if there were 101 properties that sold, property number 50, if we order in price, that's the median sale price. So the lowest price property could be $1 less than that. The highest price property could be many millions of dollars, but that median, that's the middle. But if we look at price per foot, we're going to uncover something interesting about what that skew is toward the tails, the high end tail, the low end tail. And that's why I look at price per foot. $232 per foot median sale price in February of 2023. That is down, it's down 0.9% from $234 per foot in January. Now that's actually come down the exact same percentage, 0.9%, as we saw median home price, median sale price. And that suggests that actually the distribution of sales in the market right now are pretty well split, and we're not seeing deterioration or improvement relative to the other portions of the market. The market's behaving pretty consistently at the moment. Now we are down 4.9% from $244 per foot over the past year. So that's down about 3/4 as much as the median sale price. And that suggests that we've actually had some difference if we look year over year in the distribution of sales. If price per foot has come down less, it means the upper end of the market has held up over the past 12 months a little bit better than the lower end of the market. So something kind of interesting to note. So what about units sold, right? Because we know that over the past 6 months, 8 months in particular in Las Vegas, we've been seeing very low sales volumes. And those sales volumes have been coming down and down and down. And a lot of people have been expressing commentary on this and fear about this, that the decreasing numbers of transactions means that prices are going to be collapsing, if they're not already, and means that nobody's interested in owning property any longer. Well, the stories are largely fictitious, right? Sales have definitely come down, but people still want to buy properties, and that actually shows in some of the subsequent data that I'll look at. Also, while sales have been coming down, we've not seen crashing prices, despite many commentators almost begging for crashing prices. We've seen from the peak about a 12.5% price correction, and we're down 7.8% year over year. So where is the sales volume for February of 2023? Well, this is actually another really interesting number. In fact, the numbers across February for single family homes, also for townhomes and condos, are interesting. They're not all straight line directional. There's some really important nuance in these numbers. Number of transactions, 1,519. Now, in and of itself means nothing, so we need the comparative data. This is up. It is up pretty substantially. It is up 28.5% from the 1,182 single-family homes that transacted here in the Las Vegas Valley in January. Now, we'd expect to see some seasonal growth because January tends to be the slowest month for transaction volume. But this is a really big jump in number of properties that sold month over month. We're up almost 29%, 28.5%. So that's a really encouraging sign. Now, I will say we are still, even at that number, 4.3% below the pandemic low that we hit in April of 2020. So we're still at very low volume. That January number was the lowest number of transactions we'd seen on resale single family homes in the Las Vegas Valley since the year 2000, almost a quarter century ago. So sales volume really clearly dropped dramatically from when we were in early 2022, which you can actually see we're down 37.6% from the 2,436 that we saw sold in February of 22. But we've come up substantially. And that suggests that people do actually want to be buying homes. They want to be owning homes. This is not a long-term change away from the idea of ownership. This is, we had decreasing sales volumes, largely because of what the Fed was doing to just dramatically increase interest rates. Interest rates at the beginning of 2022 had been just about 3.0% for 30-year fixed rate mortgages. and they ended 2022 at about 6.5%. So more than doubled. The Fed's been incredibly aggressive, in fact, more aggressive than we've ever seen the Federal Reserve act in such a short period of time. And so that had a significant impact on the market, because some sellers were starting to think, why would I sell my home? I'd have to buy a new one at a higher interest rate. A lot of buyers were thinking, the home I thought I could afford, I no longer can afford because my monthly payments would be so much higher. I have to change the type of house that I'm actually looking at. And so those were dislocations created by the Fed, impacted volume. Interestingly, not so much impact on price. And again, we'll see some more of that in a couple minutes. So one other way to look at this number, this 1519 sold single family resale homes in February of 2023. This is actually the highest volume we've had in resales since October of 2022. So 4 months prior. So we've bounced off the lowest volume of sales transactions now, and we're looking at something that's looking pretty good. One other point on sales volume, and this is where we start to look ahead, we start looking at pending home sales. And by the way, before I start looking forward, please, if you've not already, subscribe, smash the like button, click the notification bell so you know when new videos come out. Every month we have the market update series. And also every week I'm trying to, although it may be a little bit less frequently than that, put out new videos on the Building Wealth Through Real Estate series. Okay, so pending home sales. Pending home sales are contracts that were written in the prior month, so in the month of February 2023, that have not yet closed, that would probably, potentially, close in March of 2023. So that's a forward-looking piece of data that comes from actual market transactions from February of 2023. So pending home sales were 2,035 in February, and that's really encouraging because that's up 18.5% from the 1,717 pending home sales that we saw at the end of January. Now, it's really encouraging because it suggests transaction volume is increasing, but it's also really encouraging because we started to see in the second half of February interest rates, specifically 30-year fixed rate mortgage interest rates, coming back up. Interest rates in early February had actually fallen as low as about 6.1%. They've backed up above 6.5%. Even so, we've got really strong pending numbers for February 2035. Now it's up 18.5%, as I mentioned, month over month. It's down 23.9% from February of 2022, but do remember the front half of 2022, January through May at least, was pretty strong, and so that comparison's a little bit deceptive. This is the highest number of pending home sales since May of 2022, when the market was peaking in this last up cycle before the Fed really came in and clobbered us with significant interest rates. You may remember last year in 2022, the Fed started with 25 basis point increases, a quarter point. So if mortgage rates were going up in parallel with that, that would mean somebody went from paying 3.0 to 3.25, and then the following month 3.5. Then they started to clobber us when we got to Q2 of 2022 with these 50 basis point, these half point increases in interest rates. And all of a sudden, somebody who would have been buying at 3.5% mortgage was at a 4% mortgage, and then a 4.5% mortgage. Really aggressive interest rate increases that the Fed was putting into place, especially after the first quarter. So the first quarter of 2022, we still saw good market dynamics as interest rates were going up a bit more slowly at that time. Now, I want to make a comment here about a piece of data that I never present. And I want to talk about what that is real quickly. I want to talk about why I do not present the data. And I want to mention it because people ask me every once in a while. I have people come up to me and ask me, sometimes it's in comments, a lot of times it's in personal interactions that I have with people. Why do I not present the statistic for days on market? Days on market, which would be a suggestion to anyone, how long it's taking properties to sell. I do not present that statistic because A, it's a calculated statistic, but B, it's calculated off numbers that are actually making that kind of statistic very deceptive. So the days on market number is an indication of how long it's taking properties, specifically from the time they're listed until they go into contract for sale. The challenge is this: the only properties that get included in that statistic are the ones that have gone into contract. So if we had 100 properties out there listed for sale and they were not selling, and 3 more properties came into the market, so now we've got 103 properties, and 3 of those 3 new ones all went into contract in one day. At the end of the month, if we only had those 3 go into contract, days on market would look like 1. It would look like 1 day because that's the average for the ones that went into market. Now, let's say instead we've got 100 properties in the market and they're all going into contract at about 20 days, except for 3 of them, which have been on the market for 2 years. The days on market would show, the average days on market would show 20 days. It would have nothing to do with those ones that have been there for 2 years. So that statistic is really misleading. It only tells you about properties that have actually gone into contract. Now, one might presume, okay, if everything's priced properly and etc., then everything should go into contract in about the same period of time. But not true. A very expensive home may take a lot longer to go into contract. A high rise may take a lot longer to go into contract. Some properties may have large pieces of land and therefore they're going to have more maintenance, or some properties have pools and maybe no one's looking for pools in the month of December. So you're going to get all sorts of different days on market statistic for each individual property, but they do not aggregate in a way that's actually meaningful to you. They just simply become deceptive when we look at the average statistic. Now, with a whole lot of effort, I could go through the entire inventory and calculate that number for each of the individual properties and then average those. So it'd be a Justin created piece of data. The problem with that would be that it's still deceptive because I can't tell you how long something's going to remain on the market going forward in time based on when it happened to have been listed and when it may or may not go into contract. So there's no way to actually look at this aggregated average days on market and make good sense of it. So that's why I did not report it. So I want to make that note. So we just talked about pending home sales. What about for sale? That inventory, the houses that are actually sitting on the market waiting to be sold, right? Accumulating those days on market. Now, some may be coming in and going into inventory and they sell the next day. We'll look at new listings in a second. But most are sitting there just waiting for offers to come in. I've been mentioning over the past couple of months, contrary to what virtually everybody else has been saying, inventory is coming down, and we're going to start to see inventory challenges, low inventory, as we move forward in time. I've been saying that I was thinking we were going to start to see buyers rematerialize before sellers for a variety of reasons. Well, Justin was right. Inventory, single family resale homes for the month of February of 2023, 4,963. Now, you may, if you've been watching for a long time, know that the very first time I ever saw that number come below 5,000 was in late 2020. And then we were in a significantly small inventory, low inventory problem with escalating prices since that time. Through the latter months of 2020, all of 2021, the first half of 2022, when we saw inventory go up, well, inventory had gone up. It had gone up to about 70% of normal. Inventory now is well below 50% of normal. Interestingly, if we look on a month's supply basis, a balanced market is between 5 and 6 months of supply. We had gotten up to 4.0 months of supply. We never got back to a balanced market. A lot of people like to say this is a buyer's market. It is not a buyer's market. It's a slow moving market with constrained inventory. Well, now we can start to actually see it in the numbers. 4,963 single family resale homes listed for sale, inventory, sitting in the market at the end of February. That's 2.5 months worth of inventory. We're not in a buyer's market. There's just no legitimate way to call this a buyer's market. This is a low inventory market, and it's going to continue to get lower. So we've seen now a strong downtrend in inventory for multiple months. It's interesting, right? This is a deterioration in the number of properties for sale, multiple months, and we are at about 50%, a little below 50% of normal inventory. This is also the lowest inventory since we had peaked in this last upward cycle in May of 2022. And I could have said that for each of the past several months. We're going to see inventory continue to come down. One of the ways I know that is because I can look at the new listings number. The new listings, remember, inventory has to be resupplied. Otherwise, there'd be nothing in the market for people to buy. Well, the new listings number for February, 2,100 newly listed resale single family homes. That number is down from what we saw in January. It's down 10.8% from the 2,355 newly listed resale homes in the Las Vegas Valley in January. The number is down 30.1% from the newly listed that we had seen in February of 2022. So if we're down on new listings, that's not helping inventory build whatsoever. We're up on pending home sales, right? That's stuff coming out of inventory if it closes. We are up on actually closed sales. We've got inventory going down. It's not struggling to keep up right now. It's going down. Now, why would inventory be falling? A variety of reasons. It could be seasonal. It's not, because actually we would normally be seeing increasing new listings coming off of the low for new listings in December. We're not seeing that. We're not getting normal seasonal response on new listings. This is something I've been predicting. There are a lot of real estate agents who've been around for a really long time. There's also a lot of real estate agents who've really never been doing this before. But for those who've been around a really long time, it's easy to think back to, well, what normally happens? And what normally happens is we get this seasonal build in inventory that occurs in the winter months and in the spring to maximum inventory in June, July kind of time frame on an annual basis. But we don't have a normally functioning market here for a variety of reasons. We had been coming down so much on sales in the second half of 2022 that I had said what's happening in the market is not going to look like a typical season in 2023. And it turns out that's correct. Buyers had been coming out, but we started seeing inventory numbers come down in June of 2022. And what that meant was buyers weren't doing a lot of sales, but sellers were pulling out of the market even more quickly than buyers were leaving the market. And that's why I had been predicting that we're going to see buyers return before sellers, just like we did after the economy started to reopen with the pandemic. And I figured we'd get a similar dynamic. So that's exactly what's taking place here. New listings actually down, inventory down, and we've got buyers showing that they've returned because we've got increased numbers of pending contracts and we've got increased numbers of actually closed sales. This is something that's going to continue. And this is something that's going to actually, draw down inventory further. It's something that's going to cause pricing, therefore, to go up, where most people are predicting something entirely different than that. They've got the whole directionality of the market wrong. We have a large base of institutional owners in Las Vegas, and they're not going to sell. We've got structural transformation that's happened to the market that is actually causing inventory to remain consistently below where we would expect it to be given the size of the market. And that's going to continue to push prices higher. Now, a couple other statistics that I've been looking at over the past year and a half or thereabouts. One is back on market. That's failed pending contracts, right? Some contract is signed, it exists, it's pending, escrow has been opened, but some of those contracts will not result in a closing. They will go back into the market because they fail. The back on market numbers have been very elevated for the past, they've been very elevated actually since just before we went into the pandemic lockdown. And they continue to remain very elevated. They had been trending down some in 2022. They're no longer trending down as a general statement. They're going up, although there's fluctuation in that. So the number of pending contracts that failed in February, 677. That is 30.8% of all of the contracts written. Nonetheless, this is down significantly, but also still very high. It's down from 37.1% failed contracts in January. That means that those properties are either coming back into inventory, and they're in there at 4963 houses for sale, or they're dropping out entirely. Now, countervailing, we have increased interest rates. And that's had an interesting impact on affordability. And over the past year and a half, I've been talking occasionally about affordability. And for the past 6 months or so, I've been providing a very specific statistic. And that is a comparison on affordability from a couple peak periods. So we peaked in price in 2006 at what amounted to $448,800 in an inflation adjusted environment. And the carry cost on that, assuming a 90% loan to value 30-year fixed rate loan, at the average loan rate was $25.95 per month. So that's one of our comparison points. How do we look relative to June of 2006? The other comparison point is May of 2022, when we peaked on price in this last cycle. We peaked at $480,000. That was the median sale price in May. The median interest rate in May, the average interest rate, was 5.33%. And so if we took a 90% loan to value, so it means we put 10% in, we borrowed the other 90%. 90% loan to value loan at the average interest rate on that median house, that gave us a monthly payment of $2,391 per month. That's down $104 from what it had been in June 2006 for monthly cost of carry on the same median property. Right now, it's not literally the same property, but it's the average, the median property in the market. Well, we've come down from $480,000 in May. We've come all the way down $65,000 to a median sale price of $415,000. but interest rates have continued to go up. Interest rates the last week of February, the average interest rate was 6.79%, according to the Mortgage Bankers Association. If we took a 90% loan to value mortgage on that $415,000 median sale price property, we would be left with a monthly payment of $2,409. Now, interestingly, that's down $118 from the $2,595 that we saw in June 2006. But it's up. It's up from what we saw at the peak price in May of 2022. It's up not much, $18 per month. So if you bought that $480,000 home in May with the average 90% loan to value mortgage, or you bought the $415,000 property, median property in February, at the average mortgage of 6.79%, you're actually paying $18 a month more right now. So that means two things. It means three things. One, it means affordability has not changed from where we were 8 months, 9 months ago. It also means affordability really has not changed overall since 2006. Yes, there was a period of time where you could get, an amazing deal on a property in Las Vegas. How many of you did that? Very few. There were large institutions that were taking advantage of those incredible deals that were out there, but most people were not buying when prices were just astoundingly low. Most people, for a variety of reasons, don't do that kind of thing. They think if prices are going down, they think prices will go down further. As prices go up, some people tend to think, well, I need to wait till prices go down. Prices went down since May. They went down a lot. They went down $65,000. But the monthly cost of carry went up $18. So there's no savings in that, right? So people who are waiting for prices to come down are actually strategically making a mistake. If they want to live in a house that they own, if they want to move, it makes sense to actually do that. So the other thing that it means, right, affordability has remained approximately constant. It means there's no savings for you as an individual to wait for prices to come down. But it also means that what the Federal Reserve has been doing, causing interest rates to go up, has slowed the number of transactions, decreased the number of transactions, but they've not actually done anything to change the level of inflationary forces coming from the housing market. Yeah, housing prices came down for purchase, but rental properties haven't come down, right? The cost of carry remains the same, which means that landlords can't be lowering the prices because they still have to pay as much on the property now as what they were before. Kind of interesting. Most people have completely missed the insight in that the prices have come down, but only to the extent required to maintain a median cost of carry or a stable cost of carry over periods of time, which means that even though volume of transactions had been coming down, bounced really considerably, bounced up 28.5% in February, but volume still quite low. Sales price isn't coming down in a crashing sense. It's coming down in a very measured sense to allow the buyer to maintain the same kind of monthly carry costs they would have had if they'd been buying at the very peak of this market cycle. Now, I say that because interest rates, the Federal Reserve has virtually stated that they are going to be continuing their interest rate increase policies longer and maybe at faster pace through 2023 than initially anticipated, because unemployment's not been going up and the economy overall is not slowing In fact, the economy continues to grow. So the Fed is in this war of words with something that's just not really listening to them, not responding to them. And so the Fed is getting more and more upset, and they want to attack inflation, and they're using the wrong mechanisms to do it, partly because they don't have a lot of mechanisms that they have in their toolbox to be able to use, but partly because they've really misdiagnosed where inflation is coming from, what's actually causing it. And so the tools they're using, the federal funds rate, is actually increasing costs. It's contributing to inflation rather than fighting inflation, because it's making it more expensive to build houses, to build factories, to increase supply of computer chips or solar panels or whatever it is that's needed in the economy because of supply constraints. And so the Federal Reserve is literally causing inflation to occur by increasing interest rates. It should be noted, 30-year fixed rate mortgages usually are priced just less than 2% above the 10-year Treasury note. Now, the Fed does not control mortgage interest rates. The Fed does not control the 10-year Treasury bond interest rate. They control the overnight rate or policy rate or federal funds rate, all the same thing. That gap between the 10-year and the 30-year mortgage is elevated right now from the normally just less than 2%. If that were to collapse back down to 2%, we would actually see, even if the Fed increases interest rates by another 100 basis points and a whole nother percent, which is not within their game plan, at least statedly, mortgage interest rates probably are still staying in the 6% range. People clearly have been able to accommodate 6+% interest rates. They've been able to accommodate 6.5% interest rates. And so we're seeing volume has actually increased in number of sales and number of contracts written. And that's incredibly encouraging going forward. Now, if interest rates happen to temporarily spike again over 7%, it's a temporary spike. It may hold people out of the market for a week or 2 weeks until mortgage interest rates come back down into that 6% range. We're at the higher end of that 6% range right now. Last week, the average interest rate was 6.79%. We're still within that 6% range. And by the way, if you are looking for property to buy, talk to me, talk to someone else. Multiple lenders are out there creating new products and also competing with each other on interest rates. You can still find sub 6% mortgage interest rates. You may have to be a little bit more deliberate in looking for the interest rates rather than just simply going to the first bank and taking whatever it is they give you. But we've got clients going through buying processes right now at 5.25%, 5.5% interest rates. So there are good, better interest rates out there if you're looking and if you know where to look. Reach out to us. We can help connect you to a bank. We certainly can get you into contracts. Contracts are likely to succeed. And whether you're a buyer or a seller, we know what this market's doing. We're very good in this market. We're helping clients day in and day out build their wealth through real estate, as well as finding the individual homes that they wish to own or sell, whether those are primary residences, investment properties, vacation homes. I am Justin Miller with the Chong Miller Group. I look forward to seeing you in the next video. Thank you.